Hello, everyone. Today is Friday, May 19th, 2023. We are back in action here with episode 682 of Stock Market Weekly. We had a brief hiatus. We missed 2 weeks. Very unusual for us, but here we are again on track and ready to cover the most important trends, noteworthy moves, and price action from this week. I'm your host, Evan Medeiros, and let's jump right into it here with some of the takeaways, some of the market moving headlines here over the past week or two. Nasdaq and S&P 500 pushing to fresh highs this week. That is highs on the year for 2023. We're not at all-time highs, of course, but things are looking pretty good out there, right? Indices, if you're looking at an index picture here in isolation, things are looking good. Now, when we start to drill down underneath the surface, we look at market breadth, and we really have this AI-dominated sort of pull everything up from, let's say, a dozen or so stocks. I know it's a little bit more than that, but breadth is still quite narrow here, focused on technology, feels to have that AI kind of underpinning investment thesis that is supporting this market. Meanwhile, you also have Treasury yields, 10-year, I'm looking at specifically at 2-month highs, but really across maturities here, you're starting to see yields start to pick back up. You also have the US dollar, which is finding some follow through higher. And something we're going to talk about a little bit later is you've got volatility that is also now starting to lift back up here. So you've got quite a cocktail here of kind of extension to the upside, breadth narrowing, yield starting to pick up, dollar finding follow through, volatility getting a little bit bid. So it is a very interesting scenario, but you know, all is to say the momentum has not stopped yet, right? So the music is still playing here. You still have this nice uptrend here that is in place, but you know, buyer beware as we get up at these levels. We're going to talk about that as we get into the charts. And of course, natural gas finishing off here, also starting to turn a corner, and we'll talk about that a little bit later. So let's get into the numbers here on the week. Everything was in the green. 1 week numbers, 1.65% up, 3.5% for the S&P 500, 3.5% up for the Nasdaq 100, 2% up for the Russell 2000. World stocks lagging a little bit outside the United States, up 0.7%. Generally speaking, though, a nice green week here across the board. Now, if we take a look at our market trends across these different time horizons here, it's a pretty optimistic, kind of rosy picture. Most trends are up, you know, across even short, medium, and long term. The Russell 2000 still sees the most kind of damage taking place there. You could attribute that to mostly the financial stocks, right, with the regional banking crisis, which we're still maybe in, or maybe we're fully backstopped. I'm not really sure, but you know, certainly you've got a lot of turbulence there in the Russell 2000 as they house sort of a lot of those financial stocks. Energy stocks also getting hit a little bit recently as well, which is in that group as well. Now, volatility environment here, we're seeing some very low levels, 16.7 on the VIX here. It's generally a good spot for markets when you start to get VIX back into the teens. We are hanging out there, and we did manage to fall a little bit this week, so that was encouraging. Nasdaq vol, though, if you notice here, is at 19.82, so almost 20 for Nasdaq vol, and it was up this week. Meanwhile, we had the Nasdaq up 3.5%. So again, something to take note of. It's not a sell signal in itself. It's not, you know, stop the video and go, you know, short the Nasdaq just because of this, but it is a worthwhile call out here. When you have equity markets up large and vol rising at the same time, it should always just make you kind of take a step back, pause, and kind of reflect at the environment and situation that is at hand. Russell 2000 vol down a little bit, 22.6 though. It's the highest of the three major indices here in terms of its vol index. Now, if we take a look at market breadth, again, we had this nice positive week for US for market cap weighted indices, but if you look underneath the hood, we actually had more stocks making 52-week lows this week than we have stocks making 52-week highs. Once again, this is not a stop everything and sell type of data point, but it is something to take note of, just as the vol that we just talked about was. So again, we're not really seeing the extension in breadth, the buyers just unanimously coming in and bidding for equity market risk risk in stocks. They're very selective here, and they are sort of congregating into a handful of these very large companies. Now, I wanted to take a quick peek here, as it's been some time since we've looked at what the Fed has been up to. And if we're looking at the CME probabilities here, so from CME's website, we're looking at the Fed meeting coming up June 14th. So we're still about a month out, 3 weeks out. And right now the market is pricing in here, if you follow my cursor, about an 80% chance of the Fed just pausing and halting and kind of doing nothing here, just keeping rates at the current target, which is about 5%. There's a 20% chance that we see a 25 basis point hike, something to take, just kind of measure of and pulse on as we get a little bit closer to this meeting, what the market is pricing in terms of expectations, because this will obviously start to impact and trickle through everything. If we do get, say, a 25 basis point hike, the market's not expecting it, that you will have immediate sort of repricing of risk assets as that ripples through. But so far, looks like the market is semi-complacent here on keeping things pretty steadfast. Now, if we take a look at put call ratio here, so shout out to IBD, they sponsor our content. You can support the show, support IBD using this link here. And so this link gives you access to a handful of different data points and editorial articles. But what I'm calling out here is the put call ratio, and it's actually pretty low going into the weekend, 0.8. So you can see it's kind of on the lower end of the range here. I don't want to say it's full complacency, but certainly leaning a little bit more that way. Don't forget, we've got the debt ceiling that needs to be raised and negotiations that need to be sort of bridged, and that is still TBD, right, on where that's going to land. And we have those talks happening this weekend. And as we get into June, it's going to matter more and more. So sector performance here this week, again, you can see mostly green technology leading the pack here, 4.33%, communication services 2.84%, and discretionary up 2.5%. Very strong kind of march higher here. On the downside, you saw utilities get hit really hard, 4.26%, real estate as well, and consumer staples. So pretty defensive tone to the market that was underperforming, and a pretty risk sort of appetite tone to the stocks or the sectors that were leading this week. Again, you can see on the 1 month numbers here, take a look at just the three sectors here. I mean, this is basically what's leading the charge: tech, communication services, and some discretionary. Everything else is red over the past 1 month. So stock selection is very key here over the past few weeks. To be making money, you really needed to have that tech exposure. Now, Treasury yields, we talked about this at the top of the video, they are inching up and up. We are no longer at under 3.5% on the 10-year. We are up at 3.68%. This is a multi-month high now, and you're starting to see upticks here and breakouts of Treasury yields across the board, and this trickles through everything. You look at mortgage interest rates and everything else, the like, is back on the rise. So this eventually is something that markets are not going to like, particularly tech, but for now, it still seems to be shrugging a lot of this off and not really concerned about these interest rates that are ratcheting back up. Last but not least here, if we take a look at commodities, you can see natural gas dominating top of the list here, up 12.27% this week. It's had a really tough past year, so it is nice to just see at least a little bit of stabilization, and quite honestly, barely starts to even repair anything of the damage that has been done over the last year. Crude oil up 3%. Dollar index was up this week. Copper was basically flat. Ag was flat. Silver, Bitcoin, gold all down this week into the red here, 0.5% to almost 2% for GLD. Nice rebound on Friday, however. Last but not least here is our positioning here. So a little pulse check on our two trading systems. They're both swing trading systems. So our longer term system is Merlin here. It's 69% invested, but this is actually a very tricky number here because it actually is not a bunch of risk assets. This is holding a lot of cash or dollar, basically the dollar index, so weighted against other currencies. And it did take a pretty good chunk of a position in GLD and gold on Friday, fortunately right before the nice 1% move higher. So it looks like it got a pretty good entry there Friday morning. It was outbidding on gold. So it does have a very large chunk of this is quite safe, let's call it, and not a lot of risk assets. Our short-term swing trading system, it's been all over the place. It's been, long stocks and even short one now. So it's got two positions on right now, one long, one short, which is why you see it pretty balanced out here. with a neutral sort of exposure, but it does have, it is playing sort of both sides of this market and being pretty active. So if you want to learn more about these two trading systems, we release trade summaries, reports each and every day. We produce signals. These are all quantitative rules-based systems. They run without my judgment, built by me, but don't have me pulling any strings. So check out our website for more information there. And with that, we'll be back here in just a second with part 2. All right, we are back. We've got TC 2000 open here, and I figured I would start with a grid we don't often look at, but this is a sector grid here. So we've got each of the spider sector ETFs on here. Looks like we got IBB, mostly all the spider sector ETFs, and we got biotech in the bottom left. But what we're looking at here is essentially our smart trend filter. So this is a custom smart trend filter indicator. It measures price and volume spanning across time, and it helps smooth out trends. And it's got a little bit of kind of magic sauce sprinkled in to kind of smooth out noise and produce clean trending signals. And basically it's color coded. So green is good, bullish, right? Yellow is neutral, choppy, kind of pay attention. Red is just bearish, and sellers in control here. And so when we look at this grid, if you follow my mouse here in the top left, these 3 sectors, right? Same that we just mentioned, right? When we were looking at our sector chart in part 1, we've got technology here, we've got communication services, and then discretionary. These are the 3 bullish trends that have been really kind of dragging the market higher here. This is where you'd really need to find some concentration over the past month or so to really produce some good equity market gains. But if you look at every other sector here, and this is just a very objective measure indicator that we're using here to measure price and volume, you've got bearish or neutral readings across the board in all other sectors of the market. So this is just, again, another illustration here of market breadth and just where strength is and where strength is lacking in this market right now. And so while the music continues, I think things look pretty good, but I am always a fan of the more breadth the better, the more risk on of a market environment, generally speaking, the easier it is to make money on the long side. So we're still waiting for more unanimous, widespread buying of stocks, and it's still just at least TBD and lacking at this time. So I wanted to start there because I figured I might actually forget to include this if I didn't start there. So hopefully that was helpful. Good illustration here for you TC 2000 users. This indicator is also available on our website, so check it out there. In our TC 2000 store. So let's start with S&P 500. So it's been a couple of weeks since we've done a video here, and let's go to our old trusty roadmap, which you can see it's been a few weeks because I got to kind of pull these levels aside here. And these are market levels that we've been looking at for quite some time since we've been through this bear market and consolidating sideways. And there's only a handful of key levels that we've been keying off of and paying attention to, and you can see that we're starting to break out of or challenging the 4190 area, the zone here, as of this week. So you can see we made some pretty strong advances here on Wednesday and Thursday of this week, going from kind of the bottom end of the range to the top end of the range. The S&P 500, if I clean this up here, has been consolidating pretty orderly, neatly here around this 4120, low 4100 zone for the past 5 or 6 weeks. I mean, really since the beginning of April, we've gone absolutely nowhere in the S&P 500. That was through sort of the regional banking crisis and everything else that has been going on. And now you can see it's finally starting to make a move to the upside here and starting to break out and potentially lift above the old February highs here. So pushing to fresh year-to-date 2023 highs here for the S&P 500. We did pause a bit on Friday, but here we are. So when I look at this now with the S&P 500, breadth aside, all those other things aside, just if you showed me this chart in isolation, I'd be pretty excited about it because, you know, you've got the nice technical sideways consolidation and now you're starting to finally lift out of it after 5 weeks. So for me, in isolation, this chart looks good. But again, we do have these other context clues. That is the benefit of doing some of this intermarket analysis and looking at these other relationships, is we do understand that breadth is weak and there are some clouds on the potential horizon here. So, you know, what I would say is when I look at the S&P 500, you've got very defined risk here, especially, I mean, Friday gives you a little bit of pause, but if we start next week with a lift back over 4,200, we start moving up and putting some distance in between here, then yes, you have a great spot to manage risk against. And I would not, you know, I would not hate long exposure here in the S&P 500 as long as you're managing risk accordingly. And so if we can stay over 4190, let's call it, and we can make progress up and we can start making fresh, you know, year-to-date highs, then by all means, it looks like the S&P 500 can continue to rally. Now, on the flip side, if we start breaking back down, if we start rejecting these highs, if we get one day up on Monday and then boom, we get an expansion in range back into these levels and start cascading lower, then obviously all bets are off and it's time to get defensive. So that's kind of the way I'm looking at it. It's constructive here for sure. When you look at it like this, there's a gap and there's, you know, price movement that you could get back up to about 42.90, 42.85 or so. That gets you back to more of a busy area here. It's where we topped out in August of 2022. Those are sort of the summer highs. We also found some resistance there and some chop in April, May of 2022. So that's about, you know, 100 points higher than where we currently are. Or if you put that in percentage terms, that's basically about 2%. I mean, that could happen in a day, right? So keep an eye on that. S&P 500, though, bottom line, starting to break out of this nice orderly consolidation. If we look at the Nasdaq 100, well, this has been off to the races here. I think we did a video right before I left, in fact, when it started to break out of this range here. So this had this very sort of actionable, tight, sideways digestion in between a big zone of 310 to up around 325. It went sideways for 4, 5, 6 weeks, set up nicely, and then started to break out. And here it is, just continuing to kind of grind higher, melt up. And then you finally saw a good expansion, sort of squeeze day, maybe capitulation day for a lot of bears here on the 18th, on Thursday. And you saw again on Friday, we finally just took a little bit of a breather and paused. Now, a couple of things to note here with Nasdaq. I mean, if you look at Bollinger Bands, I think I tweeted this chart yesterday, but you can see we're starting to lift outside the upper Bollinger Band. We also had that NASVOL up on that nice big up day for the Nasdaq itself. So that was something else to take notice of. And generally speaking, we're just a little more stretched and frothy here. And we're also starting to kind of poke our head above the August highs, the summer highs from 2022 here. You can see we closed just above this area on Friday, which again was basically the highest price we've seen now, going all the way back to, let's see, about a year and a half, April of 2022, right? That was the last time we were up at these levels here. So Nasdaq 100, definitely the leader, the standout, marching higher here, and really doesn't care about any of these other bearish factors that are going on in sort of the broader macro landscape. And finally, if we look at the Russell 2000 here, this is where you've just got a lot more sluggish behavior, a lot more kind of sideways chop, and it's still trying to repair itself and stabilize from that initial crisis here. So when we finally had, or not finally, but when we learned of the banks going under here, starting with, you know, Silvergate and all the like, then that was this big sell-off you saw here in the Russell 2000. And since that point now, we've basically just going sideways, stabilizing, and it's still TBD on which way this range breaks. But you can see there's a lot of energy being kind of, you know, pent up here for a breakout in the coming weeks. So we'll keep an eye on that. We've got plenty of catalysts coming up. Of course, the debt ceiling and the negotiations and getting that raised to avoid a government shutdown is certainly going to be on everyone's radar over the next week or two, as that's basically when money runs out. So that is the landscape there for all of the major indices. Let's take a look at a couple of other Let's take a look at a couple of other areas of the market here. So we've got TLT, which is rolling over now, and I was looking forward to this as potentially being an optimistic kind of breakout candidate to the upside. I tweeted a chart a few weeks ago when we were inside this range. Technically we are still in this broader range here, but for me, the way I was sort of looking at things, I really wanted to see this hold up above, let's call it 104, 105. Right in here, this is where I wanted to see TLT hold, kind of develop a nice range here, and then kind of get that breakout and make a move back up to the August highs here. But it didn't happen. I mean, we're seeing a kind of rollover instead. We are down 6 days in a row. Maybe we're a little bit extreme stretch to the downside here, but we'll have to see. Of course, as it stands, we're still in this longer, potentially, secular trend now for higher interest rates. And if this is a trend continuation in this case, down for bonds direction, then this is obviously going to be extremely bearish for, I would say risk assets or technology. If we start to get a real big continuation and a move back to the lows here for bonds, that's going to be a tough spot for equity markets, I'd say, or technology stocks, especially the profitless sort of more growth names that rely on that cheap funding. So we'll see how this pans out one step at a time. It's still technically in this broader consolidation. I'd say once it starts losing, or if it starts breaking down below these March lows, these January lows, year-to-date lows, then you really have more cause for concern. So TLT breaking down, you can essentially look across the board here. TLT on the long end is probably the more extreme example. You can see IEF is basically right at this zone here, so maybe it's got a little more hope for it. But if it gets much further here, it starts to get pretty sloppy pretty quick. So that's Treasury yields in a nutshell. You saw gold as well take a bit of a hit here, finally kind of pull back from the highs to the lows here. It's been moving sideways. It's been strong this year, just generally speaking, but you can see this weekly candle down 1.7%. As mentioned, part one of this, our Merlin trading system actually came in and was buying the lows here, right, or basically buying the open of the session for GLD, and so far so good, up about 1% so far in this trade. Not looking to trade out of it short term, more so looking for continuation back up to highs. We'll see if that happens. Stops are in place, but the trend, generally speaking, here for gold has been pretty supportive over the last 12 months. So we'll see if that can stay alive and stay in there. Silver's bouncing the same thing after a handful of days down, starting to catch a little bit of bid. I think oil put in an inside week. So if we look at a weekly chart here for USO, it's been, selling off over the past 4 or 5 weeks or so. So it's finally, kind of stabilizing, moving sideways a little bit, kind of going nowhere though, right? Bigger picture in most of this year, it's just been kind of in this very choppy sideways with a slight drift down. And so, not a big change of character here for oil at this time. So that, I think, covers everything I wanted to mention. If we take a quick look here at industries of note on the downside, because this list is just shorter, go to a weekly chart. You can see coal stocks here, high volume, kind of breaking to new recent lows, and footwear and accessories. I think that was Foot Locker was putting in some pretty bearish remarks out here. Take a look at this, 27% down. I didn't actually catch the full story here for Foot Locker. So if anybody's got it, feel free to leave it in the comments. But big hit for retail. XRT, I think, just generally speaking, was down pretty good on Friday, 4% to the downside, given the news there out of Foot Locker. And on the upside, airlines this week. So you can see for the 5th, 6th week in a row now, moving up, but a nice move up here for airlines. Business services starting to break to new multi-month highs. Computer systems, engineering and construction, good high volume session there. Industrial distribution, that's new all-time highs it's going for. Insurance also moving to new highs. Leisure, new recent highs here as well. Railroads getting close, but trying to make new highs. Real estate as well. Semiconductor equipment, nice move there, breaking out, heavier volume. Software applications starting to break out. Software infrastructure, a lot of technology is what you basically are gathering here. So this is our industry scanning layout for TC2000. Again, if you are a user of TC2000, you can get this layout on our website. So that is it. I'm back, and hopefully everybody's been doing well out there. Thanks again for tuning in. Every Friday we do these long form market analysis videos. Things will certainly be heating up here as the old sell in May and seasonality kicks into gear, and we'll see if that's true this year, and we'll see how this debt ceiling sort of impacts all of this and the looming recession, and on and on and on with the bearish catalysts. Meanwhile, stocks move higher. So that's all I have. Leave me your thoughts below. Share your thoughts. What are you looking at? You believing in this market? You think we're going to get a rally right through a debt ceiling, raise and negotiation, and this market's off to the races? You're feeling a little more pessimistic? You're worried about breadth? You're riding technology? What is it you're up to? Leave us your thoughts below. I'd love to read it. And as always, I want to thank you for tuning in every Friday, long form market analysis just like this. Hope you have a great weekend, and we'll see you back here next week.